If you were born in the 1940s, the 1950s, or the early 1960s, stay with me for the next several minutes because the Social Security rules that affect someone born in 1948 are not the same as the rules that affect someone born in 1955, and they are different again from someone born in 1963. And if you were born later in the 1960s, this still matters. You may not be filing this year, but the decisions you make over the next few years can permanently change your monthly check. This video is going to walk through what 2026 means for each birth group, what action each group should take, and what happens to your monthly payment if you simply do nothing. My name is Mason Parker. For over a decade, I have studied retirement benefits, senior tax programs, and the financial rules that cost retirees thousands of dollars because nobody explained what applied specifically to them. Before we get into the three groups, you need one foundation: your full retirement age. Your full retirement age is the anchor for nearly every calculation that follows. If you were born in 1940, your full retirement age was 65 and 6 months. If you were born in 1941, it was 65 and 8 months. If you were born in 1942, it was 65 and 10 months. If you were born from 1943 through 1954, your full retirement age is 66 exactly. If you were born in 1955, it is 66 and 2 months. If you were born in 1956, it is 66 and 4 months. If you were born in 1957, it is 66 and 6 months. If you were born in 1958, it is 66 and 8 months. If you were born in 1959, it is 66 and 10 months. And if you were born in 1960 or any year after that, your full retirement age is 67 exactly. One important note: if you were born on January 1st, Social Security generally treats your full retirement age as if you were born in the previous year. That full retirement age number controls three major things. First, if you claim before your full retirement age, your monthly benefit is reduced. That early claiming reduction does not simply disappear later because you reached full retirement age. Second, if you were born in 1943 or later and you delay benefits past full retirement age, delayed retirement credits can increase your benefit by 8% per year up to age 70. Third, if you work while collecting before full retirement age, Social Security may withhold part of your benefit under the earnings test. But that withheld money is not the same as the permanent early claiming reduction. Keep those 3 points in mind because they explain why the same decision can be harmless for one person and expensive for another. Let us start with the oldest group. If you were born in the 1940s, you are roughly 76 to 86 years old in 2026, depending on your birthday. Most people in this group have already been receiving Social Security for years. That does not mean there is nothing left to check. There are three issues that can still affect your monthly check. The first is the Social Security Fairness Act. The Fairness Act eliminated the windfall elimination provision and the government pension offset. Those two rules reduced or eliminated benefits for many people who also had pensions from work that did not pay into Social Security. The repeal applies to benefits payable beginning January 2024. Social Security reported that it completed more than 3.1 million payments totaling about $17 billion to eligible beneficiaries by July 2025. But here is the part many retirees miss. Social Security sends notices by mail, and it uses the contact information on file. If you moved after you originally filed, changed banks, changed mailing preferences, or have not checked your Social Security account in years, do not assume everything is correct. Call Social Security at 1-800-772-1213 and say this: I want to verify whether my account was reviewed under the Social Security Fairness Act for WEP or GPO, and I want to confirm that my mailing address and direct deposit information are current. If any notice was sent to an old address, ask whether it can be reissued. If a past due payment was calculated, ask whether anything is needed from you before payment can be released. This is not about arguing with Social Security. It is about confirming that the system has the right information. The second issue for the 1940s group is your earnings record. People born in the 1940s built their careers during a very different payroll era. Many wage reports were still handled manually. Small businesses used handwritten ledgers. Bookkeepers used paper records. Name and Social Security number mismatches were more common than most people realize. Social Security calculates retirement benefits using your highest 35 years of covered earnings. If a year is missing, listed under the wrong name, reported under the wrong Social Security number, or recorded incorrectly by an employer, your benefit can be lower than it should be. This is especially important for women who changed their names after marriage or divorce and did not update Social Security immediately. Earlier earnings may have been reported under a different name, and those earnings may not have posted correctly. Log into your My Social Security account and review your earnings history year by year. Look for years that show zero or unusually low earnings when you know you were working. If you find a problem, gather whatever proof you still have. That could include a W-2, tax return, pay stub, union record, employer letter, or any document showing that you worked and what you earned. Then contact Social Security and ask how to correct your earnings record. In some cases, you may be able to request a correction online. You can also call 1-800-77-21213. If Social Security asks you to complete Form SSA-7008, complete it carefully and keep a copy before you submit it. The key is not the form name. The key is this. Do not assume Social Security will automatically find a 40-year-old earnings error. You have to review the record. The third issue is survivor benefits. Many widows and widowers in their late 70s and 80s are collecting their own benefit when a survivor benefit on a late spouse's record may be higher. A surviving spouse who has reached survivor full retirement age can generally receive up to 100% of the deceased worker's benefit amount, depending on the facts of the case. If the deceased spouse claimed early, that can affect the survivor amount. If the deceased spouse earned delayed retirement credits, that can also matter. Do not guess. Call Social Security and ask them to compare your own benefit with any survivor benefit you may qualify for. Say this: I want to compare my current benefit with any survivor benefit available on my late spouse's record. Please tell me which amount would pay more monthly. If your late spouse worked in public service and their benefit was previously affected by WEP or GPO, ask one more question. Does the survivor benefit calculation reflect the updated Post-Fairness Act amount? That comparison is free. For some households, it can change the monthly check substantially. Now let us move to the 1950s group. If you were born in the 1950s, you are roughly 66 to 76 years old in 2026, depending on your birthday. Some people in this group have been collecting for years, some claimed recently. Some, especially those born in 1959, may still be near the full retirement age line during part of 2026. The specific month matters. If you were born from 1943 through 1954, your full retirement age was 66. But if you were born in 1955, it was 66 and 2 months. 1956 was 66 and 4 months. 1957 was 66 and 6 months. 1958 was 66 and 8 months. 1959 was 66 and 10 months. Here is why that matters. A person born in 1957 whose full retirement age was 66 and 6 months, but who filed at exactly 66, did not file at full retirement age. That person filed 6 months early. On a $2,500 full retirement age benefit, a 6-month early claim creates a reduction of roughly $82 per month. That is about $990 per year and almost $20,000 over a 20-year retirement. Not because the person filed years early, because they filed months early and did not know the exact full retirement age. If you were born from 1955 through 1959 and filed at or near age 66, pull your original Social Security award letter. Confirm the exact month Social Security recorded as your claiming month. Then compare it with your exact full retirement age. If you filed early, the reduction may be correct under the rules, but you should at least know what happened and why your check is the amount it is. The next issue for the 1950s group is also the Fairness Act. If you ever worked in public sector employment, a state or local government job, a public school system, a police or fire department, a federal job before 1984, or any job where Social Security taxes were not withheld, your benefit may have been affected by WEP or GPO. The Fairness Act repealed those provisions for benefits payable January 2024 and later. If your mailing address and direct deposit information are correct, Social Security says no extra action may be needed in many cases, but if you are unsure, verify it. Call 1-800-77-21213 and ask 3 questions. Was my account reviewed for a WEP or GPO adjustment under the Social Security Fairness Act? Was any past due payment calculated on my account? Is my mailing address and direct deposit information current? Those questions are simple, but they force the issue onto the record. Now let us talk about voluntary suspension. This applies only if you have reached full retirement age and are not yet 70. If you claimed early, then later reached full retirement age, you may be able to ask Social Security to suspend your retirement benefit. During the suspension period, you earn delayed retirement credits. Those credits can increase your future monthly payment. For example, if your current benefit is $1,500 per month and you suspend for 2 full years before age 70, a 16% increase would bring the benefit to about $1,740 per month when it restarts. But this is not free money. The cost is the payments you give up while the benefit is suspended. You also need to be careful if another person receives benefits on your record. In many cases, benefits payable to a spouse or other family member on your record can stop during your suspension. So before requesting voluntary suspension, ask Social Security exactly who in your household would be affected and run the break-even math. For people in the 1950s group who are still working while collecting before full retirement age, remember the 2026 earnings test. In 2026, if you are under full retirement age for the entire year, the earnings limit is $24,480. Social Security withholds $1 in benefits for every $2 earned above that limit. In the calendar year you reach full retirement age, the limit is higher, $65,160 in 2026. Social Security withholds $1 for every $3 above that higher limit, and only earnings before the month you reach full retirement age count. Once you reach full retirement age, the earnings test no longer applies. And this matters. Withheld benefits under the earnings test are not gone forever. Once you reach full retirement age, Social Security recalculates your benefit to credit you for months when benefits were withheld. That is different from the early claiming reduction. The early claiming reduction is still permanent. Now we come to the early 1960s group. If you were born in 1960 or later, your full retirement age is 67. For people born from 1960 through 1964, this is not theory. You are either already eligible to claim, approaching eligibility, or close enough that the decision needs to be planned now. For people born from 1965 through 1969, you are not all at the same filing stage yet, but the rule is still the same. Full retirement age is 67, and the claiming choice you eventually make will be measured from that number. Here is what the 2026 numbers look like. The maximum Social Security benefit for someone retiring at full retirement age in 2026 is $4,152 per month. If that same high-earning worker claims at age 62 in 2026, the maximum is $2,969. If that worker waits until age 70 in 2026, the maximum is $5,181. That is the difference between claiming early, claiming at full retirement age, and waiting until the latest age that increases your benefit. On a more typical example, imagine your full retirement age benefit is $2,000 per month. If your full retirement age is 67 and you claim at 62, your benefit is reduced by about 30%, bringing it to about $1,400 per month. If you wait until 70, delayed retirement credits can raise that $2,000 benefit to about $2,480 per month. That is a difference of $1,080 per month. Over 20 years, that difference is $259,200. That does not mean everyone should wait until 70. Health, cash needs, debt, family history, work status, and spouse protection all matter. But it does mean you should never file at 62 without seeing your age, 62, age 67, and age 70 estimates side by side. Call Social Security or log into your My Social Security account and get those three numbers before filing. Now let us talk about working while claiming. Many people born in the early 1960s are still working and considering whether to claim at 62, 63, or 64. If that is you, the earnings test can create a serious timing problem. In 2026, if you collect Social Security before full retirement age and you are under full retirement age for the full year, you can earn up to $24,480 before benefits are withheld. Above that amount, Social Security withholds $1 for every $2 in earnings. So imagine someone born in 1963 who is still earning $60,000 per year and is thinking about claiming early. That person may lock in a permanent early claiming reduction and also have benefits withheld because earnings are above the limit. The withheld benefits can be credited back later through recalculation after full retirement age, but the early claiming reduction itself does not disappear. That is why filing early while still working full-time is often one of the weakest Social Security strategies, unless there is a specific reason to do it. Now add marriage into the calculation. For married couples, the claiming decision is not just about the person filing, it can also affect the surviving spouse. When one spouse dies, the surviving spouse may be eligible for the hire of their own benefit or a survivor benefit based on the deceased spouse's record. The amount can be affected by when the higher earner claimed. If the higher earner claims early, that can reduce the monthly income available to the surviving spouse later. If the higher earner delays and earns delayed retirement credits, those credits can increase the benefit used for the survivor calculation. That is why the higher earner in a married couple should be especially careful before claiming early. The decision may not just affect the next 5 years, it may affect the surviving spouse for the rest of their life. Now, there is one more rule for people who filed recently and regret it. If you filed for Social Security within the last 12 months and now believe you made the wrong decision, ask Social Security about Form SSA-521, Request for Withdrawal of Application. If approved, you must repay the benefits you received, including certain amounts withheld for Medicare premiums, taxes, or other deductions. The application is treated as if it did not happen, and you may be able to reapply later at a higher age. This withdrawal option is limited. It is generally available only within the first 12 months, and you can use it only once. If you filed recently and have doubts, do not wait. Call Social Security and ask whether you are still inside the SSA 521 window. Now let me bring all three groups together with one action list. If you were born in the 1940s, confirm your mailing address and direct deposit information with Social Security. Ask whether your account was reviewed under the Social Security Fairness Act. Then review your earnings record year by year and ask Social Security how to correct any missing or incorrect earnings. If you are a widow or widower, ask Social Security to compare your current benefit with any survivor benefit available on your late spouse's record. If you were born in the 1950s, confirm your exact full retirement age, especially if you were born from 1955 through 1959 and filed near age 66. If you ever worked in public employment or a job that did not withhold Social Security taxes, ask whether your WEP or GPO adjustment was processed under the Fairness Act. If you are past full retirement age but not yet 70, Ask whether voluntary suspension makes sense in your case and confirm whether anyone else's benefit would be affected. If you were born in the 1960s, do not file blindly. Get your age 62, age 67, and age 70 benefit estimates before making a claiming decision. If you are still working, run the earnings test before filing early. If you are married and you are the higher earner, include survivor protection in the decision. And if you filed within the last 12 months and regret it, ask about Form SSA-521 immediately. The main point is this: Social Security processes what you submit. It pays based on the record it has. It does not sit down with every household and explain every better option. It may not tell you that your address is outdated. It may not automatically show you that a survivor benefit is higher than your own. It may not make you compare age 62, age 67, and age 70 before you sign. And it may not catch an old earnings record problem unless you bring it forward. That gap between what the system processes and what the system explains is where retirees lose money. Now, you know which group you are in, you know what to check, and you know which questions to ask. I want to speak directly to the people watching this who realize that they may have money sitting in one of these gaps: a Fairness Act adjustment they never confirmed, an earnings record they never reviewed, a survivor benefit they never compared, or a claiming decision they made without seeing the long-term math. The next step is not another video. The next step is having the rules, forms, phone numbers, and deadlines organized in one place so you can act. That is why I built the Senior Money Defense Playbook. It walks through earnings record corrections, survivor benefit comparisons, Social Security tax withholding with Form W-4V, IRMAA appeal options when a qualifying life-changing event applies, and the common account and tax mistakes that can quietly reduce retirement income. Plain English: every form named, every phone number listed, every deadline clearly marked. The link is in the description below this video and in the channel bio. Get it today because some Social Security windows do not reopen once they close. Subscribe and turn on notifications. Every Social Security rule change, correction window, and deadline that affects your payment will be covered here in plain language before it costs you. And share this video with one person in your household or extended family born in the 1940s, 1950s, or 1960s. The conversation you start could be worth thousands of dollars to someone you care about. I will see you in the next one. And